Every year, ordinary workers see taxes automatically deducted from their paychecks, while many billionaires appear to pay surprisingly little in income taxes, sometimes even close to zero in certain years. To many people, that feels impossible or unfair. But the reality is that wealthy individuals often use legal financial structures built around assets, investments, business ownership, borrowing strategies, deductions, and unrealized gains that allow them to reduce taxable income dramatically. Today, we will talk about the unfair tax loophole that let billionaires pay $0 in 2023. So before we get started, make sure to hit that like button. Also subscribe to my channel. 10. Most people believe the wealthy pay massive taxes. When people hear about billionaires earning enormous amounts of money, they usually assume those individuals must also be paying enormous taxes. After all, ordinary workers see taxes deducted directly from every paycheck automatically. The logic seems simple. If someone earns far more money, they should naturally pay far more taxes. But the financial reality at the highest levels of wealth often works very differently. Many billionaires do not rely primarily on traditional salaries the way ordinary workers do. Instead, much of their wealth exists inside assets, businesses, investments, and ownership structures that are taxed under completely different rules. This creates legal strategies that can dramatically reduce taxable income, even while net worth continues growing rapidly. 9. Wealth and income are not the same thing. One of the biggest misunderstandings in public discussions about taxes is confusing wealth with income. Ordinary workers mainly earn wages, which are taxed directly as income. Billionaires, however, often hold wealth in the form of stocks, business ownership, real estate, and appreciating assets. These assets may increase in value by billions of dollars, without technically creating taxable income immediately. In many tax systems, gains are often taxed only when assets are sold. This means someone's net worth can grow enormously on paper, while taxable income remains surprisingly low. 8. Unrealized gains create massive tax advantages. A major reason some wealthy individuals pay extremely low taxes in certain years is because unrealized gains are generally not taxed immediately in many countries. If a billionaire owns company shares that rise dramatically in value, they become far wealthier without necessarily selling those shares. Since no sale occurred, taxable income may remain limited despite huge increases in net worth. This creates one of the largest structural differences between asset-based wealth and labor-based income. Workers are taxed as they earn, while large asset owners may defer taxes for years or even decades. 7. Borrowing against assets can replace traditional income. Another powerful financial strategy wealthy individuals sometimes use involves borrowing against appreciating assets instead of selling them. Selling stocks or investments may trigger large taxable events, but borrowing against those assets can provide liquidity without immediately creating taxable income. Since the underlying assets may continue appreciating while loans provide spending power, some wealthy individuals effectively access enormous amounts of money while reporting relatively little taxable income. This strategy is often summarized by the phrase buy, borrow, die within financial discussions. 6. Business structures create additional flexibility. The wealthy also frequently use complex business structures, trusts, partnerships, and investment entities to manage taxes strategically. Business expenses, depreciation rules, investment losses, and legal deductions may all reduce taxable income significantly depending on how finances are structured. Large corporations and wealthy investors often employ teams of accountants, lawyers, and financial planners whose primary job is optimizing tax efficiency legally within existing systems. Ordinary workers rarely have access to similar financial complexity or resources. 5. Capital gains are often taxed differently than salaries. One major reason wealth grows differently at the top is because investment income and capital gains frequently receive lower tax treatment than ordinary wage income in many systems. Governments often structure tax policy partly to encourage investing, business ownership, and capital formation. But this creates a major divide between people earning wages and people earning primarily through appreciating assets. Salaries are taxed continuously, while investment-based wealth may grow under more favorable rules over long periods. 4. The system was built around incentivizing investment and growth. Supporters of these tax structures argue that they encourage entrepreneurship, innovation, business investment, and economic expansion. Governments often want wealthy individuals and corporations investing capital into businesses, infrastructure, markets, and economic growth. Lower taxes on investment activity can stimulate expansion and job creation. Critics, however, argue that these same rules create enormous inequality because the wealthiest individuals gain access to financial advantages unavailable to ordinary wage earners. 3. Most ordinary workers cannot access these strategies. Another uncomfortable reality is that many of the strategies used by billionaires require ownership of massive appreciating assets to function effectively. Borrowing against stock portfolios, using advanced trusts, leveraging investment structures, or deferring taxes through unrealized gains are generally unavailable to people living paycheck to paycheck. Most workers rely primarily on labor income, which is visible, direct, and difficult to restructure creatively for tax efficiency. 2. Public frustration grows when wealth expands faster than taxes paid. One reason billionaire tax discussions create so much public attention is because people often compare tax burdens psychologically. Ordinary workers see consistent deductions from every paycheck, while hearing stories about ultra-wealthy individuals paying very little tax relative to enormous wealth growth. This creates the perception that the system treats labor and capital very differently. Whether viewed as efficient economic policy or unfair inequality, the contrast fuels ongoing political and economic debate worldwide. 1. Modern systems often tax labor more aggressively than appreciating wealth. The deeper truth about billionaire tax strategies is not necessarily that laws are being broken, it is that modern financial systems frequently separate taxable income from wealth accumulation itself. Because the truth is simple, ordinary workers are taxed heavily on active labor income, while billionaires often grow wealth through appreciating assets, unrealized gains, leverage, and ownership structures taxed under completely different rules. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.